This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Peter Borish. For those of you that have been around for the last few decades and happen to know something about trading and investing, you have seen Peter's name across my pages and my work, and just about everywhere else you may look on Wall Street. Peter, formerly at the Federal Reserve Bank of New York, formerly at Tudor Investment Corporation, a founding board member of the Robin Hood Foundation and Math for America. He is currently chief strategist of Quad Capital. I always love having Peter on. He has a perspective, a down-to-earth perspective that if you can't learn from, really, you've got a mental defect. If there's something you can't learn from Peter Borish, something's wrong with you. Retire, give it up. Just become a vegetable. It's all over for you. I hope you enjoy, again, another great conversation with Peter Borish on this podcast. I was thinking, I know you're a really well-read guy, and I know there's a lot of different books that are coming across your desk. But two things. Give me a couple things that you're reading right now. And also, as you look at society, gosh, we're like, what was 2008, 2009? We're now 2017. What amazes you today? What makes you wake up today? And as a guy who's watched markets, economics for decades, what just amazes you today that's novel?
Well, let's start with the books. On the business side, I'm really trying to read books that more reflect the thought process. Because if you take the markets and you say, well, we've got sort of quant on one end, we've got full discretionary on the middle, and when we get to us, we have to be in the middle, what I call quanta fundamental, right? So combination of man and machine. So I'm trying to focus on the man aspect, how it relates to individuals approaching markets in terms of changing the way people think. And we can't get away from that. One book I've read is called Mistakes Were Made, but Not by Me. And it's part of how we justify our decision making. And that relates to both markets and to our whole work in political environment. Another book on that side, of course, is Daniel Kleinman's Thinking Fast and Slow, which was the basis for Michael Lewis's newest book. And I think that that's extremely important because, again, it focuses on the fact that we tend to be more optimistic about how we approach decisions in terms of cost and length of time that it's going to take, and sort of then gets into the fact, if you look beneath that surface, of what I would say over-optimism in terms of our ability to think where markets are going to go, so too much risk. And that's something that we as a team always have to focus on, is risk-reward matters. It's not necessarily the greater the risk, the greater the reward. It can often be the other way around, and we can get into that. On the other side of the equation, I'm actually sitting here over the summer reading a Russian novel that was recently published in English called The Master and the Margarita. It came out just about the end of Stalin. It is really quite fascinating. I'm about halfway through.
Were you part of this election conspiracy thing? Is that, no?
I'm a good Democrat that believes in markets. If we want to talk politics, we can get into that. But no,
yeah, I'm pulling your leg. I'm pulling your leg. I'm sure anybody that hears an American talk about reading a Russian book as an educational standpoint right now, that's a pretty brazen statement.
I think it's important to understand the world around you. We all get into our comfort zone, whether that's watching politics, reading about politics, or thinking about the markets. You have to be very, very careful because, of course, the negative case is always easier to make, regardless of where we are in an economic cycle. So we have to step back and look dispassionately, and we're analysis, and we are risk takers and participants. We're not forecasters. The old story is, if you're going to forecast often. So if we're going to gossip, I prefer to gossip about sports. I don't really want to gossip about markets per se. We try to do our analysis and look at individual equities as, we trade long, short stock, futures, options, and go from there.
Building off my dumb joke, though, seriously, what kind of advice would you've got friends on both sides of the aisle, respected friends on both sides of the aisle. You're a very pragmatic guy. You've got your beliefs, you've got your opinions. You're very pragmatic. We've been friends for a long time. What kind of advice could you give to people out there that perhaps are finding themselves on one side of the aisle to such an extreme degree that perhaps it's affecting their life in a negative way? I think you'd be a great guy to offer some perspective on how to stay balanced.
Well, I have to say, when we first met, your humor was far better than it is now, so I need to rethink that.
I can't compete with yours.
I need to rethink that friendship. But assuming that I'm not going to finish that analysis within this conversation, it's very essential, I think, as individuals. What's your objective? Are you trying to move the ball forward? One of the things I always say when we're in meetings is, we don't want to keep the ball between the 40-yard lines. We want to move it at least into scoring territory. If you stake out everything in policy that it's all or nothing, then you're going to end up with nothing. And that is self-defeating. If I ran for president today, I'd get 35% of the vote, because 35% of the people are never going to vote for a Republican. So politics, to a certain extent, is like, being a good baseball manager. You're going to win 60 games. You're going to lose 60 games. The manager is going to affect the other 40. But if you're not willing to adapt to the data, the situation that you have on hand, you're going to end up as a mediocre team. And that's kind of where we are right now. We're muddling through. The effects that have taken place is from going back to the Obama administration, and very little accomplished there on one side. Now it's on the other side. Meaningful change takes place slowly over time. And you can weave this back into the marketplace. And we could say, well, everything's okay because the new president came in and the market's still going up. But what's the one thing that is consistently clear is that momentum continues until it doesn't. And that's where you look for divergences, you look for a slowing of momentum. So we had a very strong market coming out of the last administration. We had strong employment growth. Now, the question is that changing? So to me, trading is a second derivative question. It's not a first derivative question. Unfortunately, most people, when they're staking out sides, they're looking where they are now. They're looking at a first derivative question, and that's why accidents happen, because you need to be looking at second derivative questions.
I still remember a piece of advice you gave me, and it was a book of mine that did okay, called 10 Commandments. And I remember you saw it, and I tried to stay pretty balanced, and I wasn't really trying to give a perspective more than just kind of a basic kind of liberty type perspective. But I remember your advice was, hey, don't go down that political path. Don't go. And when I was actually redoing my newest edition of Trend Following, that from you was actually in the back of my mind to make sure, because you and I know, if you look down the roster of great traders, they're on different sides of the aisle. And so what does that mean? And when it comes to trading, not a lot.
If you let your views intersect with your trading, you're gonna ultimately end up in a difficult situation. The irony, of course, is if you were not a fan of President Obama and you missed the entire rally, and then when President Trump came in, you go, well, now it's switched sides. I'm a fan of President Trump, so you get in for this last, what's taken place since the election. And then if you're a fan of President Obama and you got out, you missed it. Your political opinions need to be completely irrelevant when it comes to your positions in the market and trading. With that said, if the market turns, if things turn, and that then leads to less approval ratings, makes it more difficult to get legislation done, the likelihood of a tax reform, the likelihood of any infrastructure, if all those decline, then, and the market has sort of discounted that positive effect, that's a completely different story. So you need to look at facts, not opinion, and nor gossip for sure. The problem is we live in a world where, and I guess I'm somewhat guilty of it, but I try to be conscious of not to do it. When you go on television or you're in the print, you want to leave something that's reasonably pithy and thoughtful. That's there. So, of course, you get a lot of attention if you go out there and say, okay, the world is ending tomorrow. You come back on 2 days and they go, hey, you were wrong. The world doesn't end yesterday, excuse me. And you go, thank goodness. I got the warning out there. Everybody took heed. It didn't end. I was right again.
Yeah, that's the logic, huh? That's the rationalization. Hey, two quick other things, real before we jump into some of your current daily life. You mentioned Daniel Kahneman, and I don't think I've asked this particularly like I'm thinking of it, but you've been around long enough to where a lot of the great thinking and the great analysis, writing, research that Kahneman and Tversky came up with. As a trader, you were living, and many of your associates were living those kinds of principles long before they won the Nobel Prize. Do you ever ponder that? I mean, some of what they won the Nobel Prize for kind of revolves around trading lore that goes back a long time. And I'm not taking anything away from them. They've done fantastic work, and the book you mentioned is great. Just kind of pointing out, it's kind of interesting.
Yeah, I read that all the time going, shoot, I should have gotten that Nobel Prize.
But I mean, there's some truth in the sense that a lot of people might not have done the academic research, but they were living Kahneman and Tversky's work for a long time.
Yeah, so that's the beauty of it, that it's related in reality. People can relate to it, but it's the demonstration of the efficacy and the theory behind it. You have to remember, an economist is someone that sees something that works in practice and questions whether or not it'll work in theory. We live in a world where we apply these things, and now thoughtful academics say, okay, is there any truth or justification to that? And you have to give them a tremendous amount of credit, because there's a lot of things that other people talk about, wives' tales, that don't work. Well, it's raining in Chicago, I'm going to sell soybeans today. You have to be aware of spurious correlations, and I think what they do is a fantastic job of outlining what is true and or thoughtful and what is not spurious. Robinhood.
I saw I believe it's recent press and a significant raise, and you guys just do amazing stuff. And I'm sure people, have heard the name over the years, but I think the idea that the group that you're involved in, the charity, to raise so much money and 100% of it goes back, whereas, and you're an expert in this, you know exactly how it works. Quite a few charities out there spend significant amount of the donations on their own overhead.
Well, we set up a model where market people, and we said, well, if the marketplace, if thinks we're going to do a good job, we should be able to continue to raise the money, which has been more of a challenge over time as we grow, of course. And so to that commitment, the board has agreed to pay the overhead. We're in a position to be able to do that. Many worthy not-for-profits are not. The thing about Robinhood recently, as we move to literally our next generation, as the founders are getting a little older, not myself, of course, that like other things.
I saw you on TV. You're looking pretty good, man. I mean, I saw you in Bloomberg.
We are in total time warp. I haven't aged today. That's why I'm a trend follower, by the way, because I ask everybody, do I look any older today than I did yesterday? And they go, no. And then I said, well, you think I'm going to look any older tomorrow than I did today? And they say, no. I see, so that's perfect. That's why I'm never going to get old. And that's why you need to be a trend follower. Just keep that trend going of never getting old. But seriously, we moved to the next stage. We hired a new CEO of Robinhood, Wes Moore, 35 years old, who's well known, Rhodes Scholar from the Bronx, a military veteran, I think was in the 82nd Airborne. We just had our first board meeting with him last week. The issue when we talked earlier about politics and how it all relates, the one thing about Robinhood, and if you were listening to some of our board meetings, is you have people from all over the aisle there. But I think we all agree on two things. One, private philanthropy can never replace public philanthropy, so we need to make sure that our public policies are good. And two, people from extreme political points of view can agree that what we need to do is help those who are less fortunate, and now let's figure out the process to do that. Sometimes that process is going to be a little heated, but the pride and joy of sitting there and seeing some of the things that we've done with charter schools and health initiatives really, come back when I step back, and I'm very proud of that.
Yeah, it's amazing. I mean, really, and this has been for a lot of your adult life. You guys have been leading the charge. It's quite an accomplishment.
Well, I think if you go back, there was a line of maybe one of our podcasts from a number of years ago, and I still believe that if you give it away, you'll make it. If you sit there and are constantly saying, not today, not today, not today, I have to make more, than life passes you by and you haven't had the opportunity to give it away. And even though, given the trend following that I'm never going to get older, when you're 30 and you're thinking about the fact, the line is always, he who has the most toys wins. As you get to be a little older and you look back and you see your own family and things, you realize there's never been a hearse with a luggage rack on it. So all this accumulation isn't inherently necessary, but the quality of life of those around you is far more important.
Let's dig into a little bit of trading today, because I think that is near and dear to you right now. Give me a little bit of a background on how the Quad Group has come to be. I think one of the things I always try to look at when I look at a relatively new fund, you guys are looking about a 3.5-year track record. And it's a track record that obviously is going to make a lot of people excited and a lot of people interested in your work. And I was trying to count the negative months. It looks like about 5 or 6 within that 42-month window. And it's pretty consistent. It looks like your biggest up month was kind of a plus 6%. Your biggest down month was a minus 11%. And it looks like as time has gone on, that larger variance in terms of performance has actually gone down some. Speak to the genesis behind this multi-strategy approach. And I've got a zillion pieces of paper here in front of me that we can kind of go off in a lot of different directions on what you're up to today.
Thanks for asking. First of all, every successful trader has a near-death experience, and I just hope they usually have it before they come on our platform. In our case, that October 14, that bad month, which was relatively early in our life, there was a big deal that broke, and we had fewer traders in the multi-strat, more concentration. So, it's one of those accidents that happen. The tough part about this business is a similar accident is unlikely to happen, but a different one is likely to happen. So one always has to be prepared for that. So how have we done that? So our view of life is very simple. In very short run trading, man versus machine, machine is one. We can't compete in that high speed, high frequency space. In longer run trading, you don't need us to pay me 2% to be long Google or anything else. Markets work. Wall Street's very good at creating products, whether that's ETFs or indices or lower cost products for that. What we look for, we believe that 2 and 20 is not over. It works if you could try to get to the low to mid-teen returns. How does that work? We look for alpha generating, capacity constrained strategies. And so if you're an individual and you have a strategy that maybe can manage up to 150 million on your own, that's a difficult proposition to run a business these days, even at 2 and 20.
Boom. Technology failed Peter and I for just a moment. But don't worry, we're right back. The risk management side of the equation. I'm looking at a list right here in terms of the things that are involved in your risk life cycle. It's the strategy, track record, product coverage, pre-trade limits, exposure limits, concentration limits, liquidity constraints, balance sheet constraints, daily drawdown, cumulative drawdown, compliance, performance analysis. If somebody out there wants to have maybe some simple type strategy, okay, and trade their own account, that's one thing. But how in the world does somebody sit at home and imagine themselves, and you were kind of getting at this before we got cut off, how in the world does somebody compete with an operation that is breaking risk management down to that granular level? That's a tough challenge.
Someone trading at home is completely different because they're not running a business. They're managing their own either personal net worth or their risk account, which they're doing. I think the most important distinction for that is our business is about, is it a successful day? Did you make a little money and you ended the day up? When you're at home and you're trading, it might be completely different in terms of what your risk tolerance is. If you have a trading account, but it's only a small fraction of your net worth, you may be willing to take much more volatility in that account. We can't have that volatility from a business perspective. People are giving us their assets to try to have a non-correlated, differentiated path of returns. They're very, very much different. We are in the business of managing risk. We're not in the business of trying to be right. That's a very, very big distinction. If you're a larger hedge fund, if you're an activist investor, you're accumulating a large position, that's something that you have to try to be right in. One of the questions I ask of every one of our potential managers is, are you interested in making money or are you interested in being right? Because we're interested in making money. So what does that mean? It means when we go back to that earlier notion of risk and reward, and it's the wives' tale of the greater the risk, the greater the reward is not necessarily the case. Where you turn it upside down is if you have very low risk and you can define that point. Now, whether that's an inflection point, because if you're a trend follower and it's breaking down, or you're a discretionary trader and you think there's a reversal, you have to have that risk management. The difference for us and a mechanistic trend following, and I relate to that because that's your area of expertise, is that oftentimes in a trend follower, the faster you make money, the worse it is because your model says you can't move your stop. We have no problem encouraging people to say, wait a second, let's look historically, let's look at the data. This is a 90% move over 4 days. Are you going to stay in this position to bet that it's a record? Or should you be taking something off the table and then knowing that if the trend is still down or up, that you can put it back out? That's the advantage. Transaction costs are low. Information gathering through data sources, through news sources are inexpensive, and one should be a bit more flexible and willing to do that. And also, if you're a discretionary trader, of course, your mind is an entirely better place when you don't have a position on versus when you do have a position on, because when you do have a position on, and this is part of my role, is you're often talking yourself into why you should continue to have that position on. You need to have that objectivity. It's why no matter who you are, if you're Tom Brady and you're in the film session, you always have a coach with you. The coach isn't saying, hey, I'm a better quarterback than Tom Brady. You need a sounding board. You need advice. You need someone that has experience. That is the very, very difficult part when you're home alone and you're trading on your own. It's a lot of pressure. Should I keep the position on? Should I get out of it? Do I have too much on? when you come to pure trading, it's never, you're always upset. Because if you have a trade on, it's a loser, you shouldn't have had it on in the first place. And if you have a trade on and it's a winner, you should have had more on. And that's just a simple fact of life. So we're always thinking about ourselves. You're a baseball player. I'm a baseball fan. I was never as good as you were as a player, but you can't think of your last at bat. That's where looking at it, that's where risk management comes in. Trading is not defined as success as to whether or not a trade is profitable. A trade is defined as successful is if you have the same variables, the same setup, and the same probabilities. Would you make the same trade? It's a probability game. If you do that, then you're there. And I would recommend almost everybody, when they talk about trading and risk reward, and particularly unit size when they start trading, to understand the Kelly criteria when it comes to betting, and how many bets you need to do and how you bet when it comes to that. Almost everyone, and I said this before and I'll stress it again, trades too large relative to their perceived edge, and that's when they have difficulties when they go through a drawdown. We're on top of that. So when it comes in terms of our risk management, whether that's just initially, hey, a tap on the shoulder. You see what's going on here, your volatility's picked up a little bit. Nothing out of bounds, to actual rigorous rules of, okay, you need to cut this position. Okay, you need to take some time off.
I don't see it in your list, but I did see it in your presentation talking about, and I hope I've got this exactly right, but the ability to liquidate all positions, all strategies in 3 days or less. Speak to why in 2017 that's an important piece of information to potential investors. Speak to that number itself, 3 days or less, and perhaps give some perspective going back. I'm assuming to put that number out there, harkens back to the fall of 2008. Perhaps even for you can go back to 1987 and think about these things. Give some perspective there on that number and the thought process.
Our business is, as I said earlier, about trading level one products, exchange traded, that are marked to market. That's our distinction. So if you're an investor in our fund and we say you can redeem with 30 days notice, that we have to match up our assets and liabilities. So if we're trading in exchange traded products around the world, now if it's a Friday, and someone has a position on in Japan or overseas, then you can't get out that Friday. You have to wait till their Monday. So that's where it is. But we can always do that. Everything's mark to market. Everything's there. We have volume constraints. We have liquidity constraints. We need to do in practice what we say we're going to do. One of the issues in the hedge fund space in '08 was the fact that the assets of the hedge fund did not match up with the liabilities, which was their redemption schedule, and then you got into gates. Investors don't want to see that. Remember, we are running a business. We have to say to our investors, here's where it is, and then we have to implement it in progress, because if one time that doesn't work, it's a small community, it's going to get out there, that's going to hurt your business. So we're very, very conscious of that. And that's why we control volatility, and we go to all these other things that we were discussing.
You're running right now a multi-strategy approach. You're welcome to add some color there to the different strategies. But I'm curious, are you wedded to the current grouping of strategies, or is there flexibility in the approach to where, you, Peter Borish, someone comes in the office and they go through that process with you of perhaps onboarding with your team? Are you wedded to the current strategies, or are you open to someone walking into the door with something entirely different that if it would fit into your process from a non-correlation standpoint and add additional value? Speak to that.
They have to, as long as it fits within our constitution, which is exchange traded level one products. They have to have a real-time track record. We have to verify that track record. We're always looking for new talent. We're like every other business. We're looking for talent, and we're looking for capital. Our door is always open. I spend a lot of my time looking at bad numbers because many people think that they can do this business, and it turns out very few can, and that's just the way it is. There's a lot of recreational. So if you talk to people at home who trade at home, they can be a very good recreational ball player. That's fine. But we need to have those players that have the potential to make it to the major leagues. That's our whole thing. We start with them. We start small. They have a real-time track record with principal trading. We take our own capital. We eat our own cooking. We put that risk first. Once that's completed, then they can move up the chain into our multi-strat hedge fund. No one's going to be in that hedge fund unless they've had a real-time track record, and I don't care how great you are. When you switch teams and you come onto our team, you have to get comfortable in our environment, and you are what your track record is. There are no excuses. It was raining. It was this. It was that. It's your track record. If your track record benefits and you're doing well, then you can move up.
So someone comes, and let me just kind of go off on a side tangent here based on what you're saying. Someone comes into the office. They have the sit down with you. They've got the track record. Perhaps the track record looks good. But you've been around a lot of people. You've had a lot of different experiences, good personalities, bad personalities, people you want to work with, people you just can't stand. What's one of the worst things that someone fresh walking in to sit down with you, you've multi-decades experience on Wall Street, what's one of the worst things that people can do sitting down with you for the first time?
Make excuses for their mistakes rather than owning them. You need to learn from your mistakes in this business. We all make them. As I said, you are what your track record is. Own up. This is a business where if you don't know yourself, if I don't think you know yourself, particularly if you're more of a discretionary trader than a quantitative or a systematic or a model-based trader, then that's going to turn me off. The other thing is, in this day and age where your personality matters, if we can do business with anybody, we're going to do business with people we like. The day of sort of the eccentric person sitting in the corner doing their thing, that's not culturally what we want to have. We want people to be collaborative. If you're trading energy futures and we have somebody that's trading, the pipelines, ExxonMobil's, and equity, we want them to talk to each other because you could see things, whether it's the term structure of the futures curves or pricing of options in some of these equities, that has information. We're on the same team. We want to win.
Go ahead for the audience and give some thought process behind the non-correlation aspect, because I would think in perhaps years past, and it's not, necessarily 100% novel, but the idea of having these multi-strategies under one roof, in years past, you might have had 4 different funds with these different strategies, and perhaps somebody was then assembling a fund, all these different strategies together. You guys have done that as the offering, as the opportunity for investors. Speak to the big picture thought process there. Perhaps even go into, I'm not familiar with the members of your executive committee, but perhaps speak to some of the backgrounds and how this came together, why it's all come together.
Well, the difference is that when you have a multi-strategy hedge fund versus sort of multiple strategies, the investor only pays if the fund in the aggregate is in new high ground. So if manager A is making money and manager B is losing money, then you don't pay anything. In the other case, you were paying multiple fees, maybe sometimes multiple management fees, different incentive fees, where it was a little bit of the fund-to-fund structure that was more expensive to the investor. We think that the model going forward has to be the investor interests and the firm interests have to be better aligned. And so that sort of comes out of the background of the founding partners. Now, again, I'm a coach in seriousness. This is the next generation. The founding partners here, they're in their late 30s to early 40s. They're in the hungry spot. They came up from the principal trading side. They have their capital at risk, as all the partners do. They are risk takers. They are involved in the multi-strategy fund. They get it. That's another unique thing about what we're doing. We have a lot of skin in the game. We have more skin in the game in the sense that before someone comes up into the fund, so we have a pipeline of people, all of them are taking our own credit risk and capital risk. And then as they move into the multi-manager, multi-strategy platform, it's been better. In fact, as the early stages of this business has grown, you're better off having been an investor in the hedge fund than me just as a partner, because we've spent a lot of money building the business in terms of systems, risk, monitoring, and of course, capital risk, and some new traders. We don't believe at all in sort of the, hey, I'm a smart kid and give me a shot and the spaghetti against the wall. That does not work. We want people with a real-time track record, and we're scouring the universe literally for that. In the early stages of the business, everybody had to be in our New York office, and I reluctantly came to the conclusion that not everybody wants to trade out of Lower Manhattan. So we upgraded our systems, real-time risk monitoring, paralleling in terms of trade execution. So now we can have people in different locations trade for us, but they have to be alpha-generating, capacity-constrained strategies. Tough business, tough to find the talent, tough to grow the talent. And that's one of the things that we're very good at, is nurturing and seeing and looking at all sorts of different models as to whether or not they're able to deploy more capital without deteriorating their returns.
You know, I always love conversations with you because, you know, look, you're a capitalist. You've got your venture. You've got Quad Group right now. But when people listen, let's say, you know, there's going to be people listening that perhaps say, gosh, you know, I really love the way Peter thinks. I love his process, frankly, his search for the truth. But there's going to be other people listening that are just like, wow, I'm getting something from this because I want to be the next Peter Borish. I want to go down this path. And they get a chance to kind of listen in to not just kind of a pitch per se, but to listen into how you think and all the little steps that go along the way. It's always fun. It's a double-edged sword in the sense that there's different audiences that can take away. There's different takeaways for different audiences. Bottom line,
you have to be your own person. Yeah, in terms of the business and how you approach things, you can't be me or anybody else. One of the main things I'm always telling people is you have to trade your own personality. That's when we talked earlier about if you're sitting at home and you're trading for yourself, what is your risk profile? It doesn't matter what my risk profile is. You have to know yourself.
Okay, the biggest question I have as we wind down, now that the Mets have the greatest quarterback ever to see the NFL in the minor league system, it's only a matter of time, right?
The issue is that you don't throw the ball from home plate to first base. You got to throw it. You have to hit the ball if you're moving to the outfield. I think Tim Tebow is an amazing athlete. I think he's a fantastic person. But if you want to switch to a better analogy when it comes to our business, it's a perfect segue, because everybody that comes to me and sits down and they go, hey, I'm Michael Jordan. I'm going to be there. You want to have me. And I'm like, I completely agree that you're Michael Jordan. The thing is, I have to figure out, are you Michael Jordan on the Bulls or are you Michael Jordan on the White Sox? And guess what? Where are most people? They're Michael Jordan on the White Sox. You really, really have to understand yourself and your limitations.
That piece of advice, though, goes far beyond trading. You just offered the audience a great piece of life advice, frankly, regardless of their endeavor.
Yes, and that's why it's difficult, because one of the reasons that initial risk takers and traders tend to be a little bit younger is because they don't know themselves so well. So they're humble, they're optimistic enough that they're willing to take the risk, and also they don't have haven't accumulated as much capital, so they're willing to take the risk. Oftentimes in this business, let's say when the 2 becomes more important than the 20, the risk, the interest of the investors and the manager diverge. We don't pay any of our managers anything but part of the incentive fee. So the investors and the managers are always lined up in terms of incentives. And as an economist, and when you sit back as an individual and what are your incentives? Where are they? And are they lined up, whether it's at work or trading? Because again, you get nothing. If you go around and you tell people I was right, and most people, then that's fun. But really what matters is, did I make money? And a lot of times you've lost money and you got out and then you were right. And then you tell everybody, wow, I was right. But I don't care. I'm interested in, did you make money?
And it's funny too, when you say that to make money, it's not a bad thing. I mean, I could see some people in the audience, perhaps, I don't know who these people are in my audience, but maybe they're sitting back there going, well, gosh, that sounds, the focus on money, but it's like, hold on. That is the nature of this business. That is the nature of your business. This is, you are taking your own capital, you're taking client capital, you are taking a risk, and you're only doing this because you think you have the insights to get more than the risk that you're taking. I mean, this is life. This is how life works. It's a good thing.
It can be stressful. It can be stressful. And you have to, as a result of that, you have to know how to let it go. You have to have balance. It's critical. You've got to clear the head. If you're at a point when you're trading and it's Friday night and you're staring at the screens when all the markets around the world are closed, you need to take a break.
Where can we send people, Peter? I know the website is quadgroup.com. Anything else? Any other place we'd like to send them?
Well, if people are really interested in a firm or not, obviously we have an info at quadgroup.com. Remember, we have a hedge fund, so it's highly regulated. So for people to invest, they have to meet certain standards. On that one side, on the other side of the equation, if you have a real-time track record and it's verifiable and you're trading these level one products, obviously mark-to-market, exchange-traded, and you'd like to share that information, you can also send that to info at quadgroup.com. And I promise you one thing, we will get back to you. We're a small firm, we're a growing firm. Going to that analogy, if we have to go to Iowa in the middle of the summer, it's 90-degree heat to look at that potential catcher, that's what we do. So if you're out there and you think you have some talent, send it our way.
I would be surprised if you don't get people that come your way on that. I hope the folks that do, I hope they don't violate those cardinal rules we were talking about the first time they sit down with you. So I hope everyone is thinking about the many things you've said in this conversation today, because you've basically told people not exactly, but you've given people a very good rundown for the thought process that goes on at your firm. And if they do want to reach out, whether it's client or a potential new trader, you've given them a very good idea of how you think and how to approach this.
Well, thank you very much. I appreciate those kind words. And we'll see. We're starting here as another day in the U.S. where there's zero volatility. At some point, that'll change. By the way, we're seeing all those types of strategies. That sell volatility strategies. That's not something that we're going to look for. As I always like to say, if you bet on records being broken, you sort of go broke because you run out of premium before it breaks. And if you bet against records never being broken, you get destroyed on a gamma play when it does get broken. So that's why this is a very tricky business.
Well, Peter, it's interesting, kind of as you bring up the idea of where we are today in 2017, there is a generation of folks that don't know anything except a straight up S&P, a straight up NASDAQ. They don't know, there's no other experience. I mean, they could do the back test, but their personal experience is one of a big bull.
Look, if you look back on everything, and we have the 30th anniversary of the 87 market decline, if it just looks like a little blip, maybe they have the right attitude. We won't know. That's the beauty of the markets. It's always confounding people, and that's why we say It's risk reward that matters, not trying to be right.
There you go. I agree with you 100%. Peter, thank you. Thank you for your time.
Thank you, and look forward to following up. Have a nice one.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.